What is a surety bond? It sounds scary, but it's not. A surety bond is purchased by a company or individual as proof of financial responsibility guaranteeing performance, payment of taxes or wages, or compliance to rules and procedures. Similar to insurance, but different in one key way, the beneficiary. A surety bond is required to be purchased to protect the business's customer base from any negligence, fraud, theft, or contractual promises broken. Here's an example of a surety bond. It's a legal document involving three parties. 1. The principal. This is the business required to purchase the surety bond. 2. The surety. The surety is the insurance company that writes the surety bond and guarantees payment on any legitimate claim against the bond. 3. The obligee. This is the entity requiring your business to purchase the surety bond. In most cases, the obligee is a government agency requiring a surety bond as part of the licensing process. The government may be at a federal, state, county, or city level. In some cases, it's not a government agency at all. It could be a customer or a client, as in the case of a business service bond. Let's look at some examples of the most common bonds and how these three parties interact in the surety bond agreement. Example 1. Contractors, including general contractors, electricians, plumbers, and other contractor fields. Almost all state contractor licensing boards require contractors to purchase a surety bond to obtain their license. Some cities and counties require a separate bond for municipal licensing as well. The state licensing board is the obligee. The contractor is the principal. The surety is the insurance company writing the bond for the contractor. A contractor's surety bond protects customers of the contractor from poor and unfinished work on the project. Example 2. Auto dealers. All state Department of Motor Vehicles require non-franchised auto dealers to purchase a surety bond to obtain their dealer's license. The auto dealer is the principal. The Department of Motor Vehicles, or Secretary of State, is the obligee. Again, the surety is the insurance company writing the surety bond. An auto dealer bond protects the car purchaser from improper title transfer, falsifying a title or floating a title, falsifying information about the vehicle like mileage, mishandling customer deposits and funds. In some cases, an auto dealer bond also protects the state and county government from dealers who don't pay appropriate taxes like a sales tax, use tax, or fees like the California tire fee, plus dealers who don't follow the strict dealership setup requirements outlined in a license application. Example 3. Commercial cleaning companies. Governments don't require a cleaning company to purchase a surety bond. However, the company or homeowner hiring the cleaning company may require the company to be bonded. This means they must have a valid surety bond. The hiring business or homeowner is the obligee, the cleaning company is the principal, the surety company remains the insurance company writing the bond. This type of surety bond is called a fidelity bond, and in this specific case or example, it's actually called a business service bond or a janitorial service bond. This bond protects businesses and homeowners hiring the cleaning company from employee theft while the employees are on their private property. That's only a few examples. There are thousands of different types of surety bonds, but don't worry. We have bond specialists that can help you find your specific bond. Let's look at a few other examples real quick. Alcoholic beverage tax bonds, freight broker bonds, probate bonds, notary bonds, health club bonds, even a vicious dog bond. So how does a business owner purchase a surety bond? Step 1, know the bond you're required to purchase. The obligee will tell you to purchase a surety bond. However, they might just say, purchase a surety bond. In most cases, you can find the bond you need by searching your company or category, your company's category, plus the word bond. Try our bond search at suretybondsdirect.com. I bet you'll quickly find the bond you need. Keep in mind, some businesses, like cleaning businesses, will opt in to purchase a business service bond to earn their customers' trust. Step 2, work with a specialized surety agent. First off, most surety companies don't work directly with consumers, requiring you to use an agent. When choosing an agent, choose a specialty surety agency like Surety Bonds Direct. A specialty surety agency has relationships with many insurance companies, allowing for multiple quotes and the ability to get the lowest possible price on a surety bond. Step 3, get your bond cost. A surety bond typically has a specific amount required by the obligee. This is the amount of protection provided by the bond, usually called the bond penalty. A legitimate claim will only be paid up to that amount, never greater. The price of a surety bond depends on the type of bond you need. Some bonds have flat fees associated with them, like notary bonds, specific contractor bonds, specific alcohol tax bonds. For example, a 1-year $10,000 Tennessee alcohol tax bond would cost $100 flat. Some bonds require a premium to be calculated based on personal credit, business experience, business financials. For example, if you have good credit, a 1% rate may be available for any given bond. So if you're purchasing a $25,000 contractor bond, your cost would be $250. For someone with poor or limited credit, a 3% rate might be the best available. So for the same contractor bond, the cost would be $750. Each surety company has its own underwriting guidelines and pricing guidelines. This is why it's so important to work with a specialty surety agency like Surety Bonds Direct, who can get you a wide variety of quotes for the lowest possible price. Once you purchase your bond, you file it with the obligee, or you might send it in with your license application. In some cases, we can actually file it for you. Step 4, renew your bond when required. Some surety bonds are continuous, meaning they will automatically renew on their renewal term, provided you pay the renewal premium. Other surety bonds don't renew, so you need to purchase a new bond on a yearly basis. We make this process easy by checking prices in advance and reaching out to you prior to your bond expiring. If the bond amount changes, we'll get you new pricing quickly to make the renewal process simple. In the description below, I've linked to another video explaining the difference between a surety bond and an insurance policy. If you have any questions about what a surety bond is, ask in the comments. I'll be happy to help answer it. If you know the bond you need or you're looking for a surety bond, go to suretybondsdirect.com. You can get a free quote online, or you can talk to one of our bond specialists on the phone. They're really good at what they do and they're here to help.